And I should say that precious metals prices generally go higher when people are concerned about the maintenance of the purchasing power of their investments and savings in other instruments.
Seems to be really quiet on the gold and silver front during this period as precious metals prices approach 2 years of consolidation since their last peak back in August of 2020. Are you feeling that we are in a darkest before dawn phase for gold and silver right now? And is morning coming soon?
There's no absolutes in life, I've learned, Patrick. There's only probabilities. And the probabilities are, unfortunately, that precious metals are going to do extremely well. I say unfortunately because precious metals have had a role for a millennia as insurance against the failings of government-inspired savings and credit instruments. Let's look at the reasons why it's probable that precious metals prices go higher. And I should say that precious metals prices generally go higher when people are concerned about the maintenance of the purchasing power of their investments and savings in other instruments. So why might people be concerned? Well, quantitative easing would be the first. We said this on your show before, Patrick. If you did it, it would be called counterfeiting. But creating more currency units with nothing to back them, whether you agree with it as policy or not, devalues the existing units in circulation. There can be no getting around that. The second is, of course, debt and deficits, which is a creditor, which is to say, as a bond buyer or a depositor, what you are. I don't know the numbers for other parts of the world, but in the U.S., the on-balance sheet liabilities of the U.S. government is approaching $31 trillion. 23 trillion net of the Fed's balance sheet, which is to say net of counterfeiting. But the off-balance sheet liabilities in the U.S. are even more staggering. The net present value, not the long-term nominal value, but the net present value of on-balance sheet liabilities of the U.S. government, things like Medicare, Medicaid, Social Security, pension benefit guarantee, exceed $125 trillion. So the on-balance sheet and off-balance sheet liabilities at the federal level before state and local debt approach or exceed $150 trillion. And we propose to service this debt with a budget that is itself in deficit as to $2 trillion a year. Rather than service the debt, we add $2 trillion a year to it. That might cause people to be concerned about the efficacy of the U.S. dollar and U.S. dollar-denominated savings products. But the worst is, of course, negative real interest rates. The idea that savers forestall consumption and assume credit risk against a guaranteed loss. The idea that you save at 3% in a currency that's depreciating at 8.5%. By its very nature, the fact that you are guaranteed to lose money on savings instruments, guaranteed to lose purchasing power on savings instruments, I would suggest almost guarantees inflation. Now, let's look at two other pieces of math. The first is that despite all these tailwinds, precious metals are broadly underowned relative to historic norms. It is estimated that precious metals and precious metals related securities have a 0.5% market share in the U.S. market versus a 40-year mean of between 1.5% and 2%. So if the tailwinds eventually change investor behavior so that demand for precious metals and precious metals related assets only returns to mean, demand for those products will somewhere between triple and quadruple. And here's why it'll happen, I think. The biggest institutional investors in the world, the pension funds, the big endowments, the insurance companies, have benefited from 40 years of declining interest rates. And their portfolios have traditionally been 60% equity, 40% debt. The long-term debt, of course, benefits more from declining interest rates. But that party's over. We've seen from the action in the U.S. 10-year Treasury that this 40-year period of falling interest rates is over or almost over. Imagine yourself, Patrick, running $1 billion, $1 trillion just for fun, sovereign wealth fund. and you own $400 billion in long term debt. This debt is yielding you 3%, while it is reducing in your ability to service your pension obligations by 8.5% a year. In other words, 40% of your portfolio is guaranteeing that you will be unable to fulfill your mandate. My suggestion is that we're going to see massive disintermediation in the long term debt market. And while I don't think that all of that money is going to flow into gold, I think enough of it is going to flow into precious metals that precious metals at least resume the market share that would suggest a 40-year mean, which is to say between 1.5% and 2% of the total value of savings and investment assets in the United States. If that would occur, I think that you will see a dramatic bull market in precious metals.
Speaking of gold, a previous guest on our channel mentioned that revaluing gold upwards could be a way for the U.S. to solve its debt problems if they do indeed have that 8,000 plus tons of gold. Could this be the next easy solution after the easiest solution, which was money printing, completely fails?
Uh, Monetizing the U.S. debt in gold is deflationary. It would have an amazing impact on people who had been schooled for 100 years uh, to expect easy money. There would be, I suspect, massive unemployment. I suspect there would be massive foreclosures. I think the idea that the U.S. would ever evolve to honest money is a non starter. I think the political system is at once too ignorant and too cynical ever to allow that to occur.
I mean, despite that, and given your experience, would you say that holding gold and silver pretty much a must today, given the trajectory of the global economy?
I don't want to tell other people what to do with their money, uh, but I regard gold and silver as assets that, among other things, allow me to sleep well at night. And at 69 years of age, I like my sleep. It's difficult for me to imagine why somebody wouldn't have some of their have some of their liquidity, at least in gold and silver. If there are people out there whose own business or own investment acumen is so good that they can overcome savings yields in the 3% range while the depreciation of their savings runs at the 8.5, 8.6 level, perhaps they don't need to own gold. If there are people out there who understand a way through $150 trillion in on balance sheet and off balance sheet liabilities at the federal level, perhaps they don't need to own gold. I'm not that smart, so I do.
Okay. Rick, with the US dollar, we of course are seeing it rising on the DXY as mentioned. And this is pretty interesting because on one hand, the dollar is getting stronger, somewhat creating headwinds for things like gold and silver and commodities. And on the other hand, people are selling their assets such as gold and silver to move into dollars. What should an investor weigh in more? A strong dollar to pick up opportunities that are coming, or having a safe haven asset against inflation that'll chip away at his dollars?
Unfortunately, the answer to that is yes, Patrick, and let me explain. Despite the fact that holding cash in any currency reduces your purchasing power, you have to own cash and lots of it. And the negative real interest rate that you suffer, you need to regard as an insurance premium and an option premium. I have been through, depending on how you count, 4 or 5 liquidity squeezes in my life. Crises in confidence, things like 1987, things like 2006. Um, in those periods where liquidity dries up, having liquidity gives you both the courage and the tools to take advantage of market turbulence rather than being taken advantage of by market turbulence. So, do investors need to hold U.S. dollars? Sadly, yes. Do investors need to own gold and silver? In my estimation, Sadly, yes. Investors need to maintain liquidity during periods of change when there is a probability rather than a possibility that we'll have a crisis of confidence and illiquidity. And from my point of view, part of the liquidity which I like to hold is in gold and silver, despite the fact that they are volatile liquidity. It's interesting to me, Patrick, that many people value their gold in dollar terms, which is to say they value an asset that for 1,000 years has been a store of value and is at once a store of value and a medium of exchange. They value it against an artificial construct, the US dollar, a floating abstraction. I try about once a quarter to recast my own personal balance sheet and income statement in grams. That is, I'm trying to teach myself at age 69 to have the constant in my own portfolio, both my balance sheet and my income statement, in gold rather than dollars. I haven't managed to change my mind to do that yet because when I go to the store, stuff isn't priced in grams. But it's very useful to begin the process of programming your mind to at least consider your finances in the context of a constant rather than in the context of a floating abstraction.
Yeah, that is something I do all the time. If I'm at the mall, I'm looking at the price in dollars and I'm looking at it, well, how much ounces of silver or grams of gold is that? And that's a great point where gold is a store of wealth, but we're measuring against a fiat currency that is losing its purchasing power.
Correct. And in fact, something that's very difficult to value. Remember, and I'm not knocking dollars. Mercifully for me, I have lots of them. Uh, but a dollar and even a bond really is a promise to pay. Gold isn't that, it's payment. You don't have to have any counterparty trust. It is at once a store of value and a medium of exchange. And I'm not saying that gold is going to drive US dollars out of circulation. All I'm trying to say is that in dollar terms, gold is going to revert to its 40-year mean. And I think that will usher in a spectacular move. You should note that in the period 1977 to 1981, that precious metals were double and perhaps triple the 40-year mean, which is to say that the value of precious metals assets at the end of that first bull market were probably 6 to 7% of the value of savings and investment assets in the country. So there's no necessary reason why the ascent of gold and silver's market share would be limited to the 40-year mean, because the circumstance that we find ourselves in today, negative real interest rates, debt and deficits, and quantitative easing, is substantially more dramatic than we have experienced as a society for at least 30 of the 40 years that were covered in the mean.